My name is Michael King. In this second video on capital budgeting, we're going to look at net present value and the profitability index. In Booth, Clear, and Rikita, this is going to be sections 13.1 and 13.2. So what is net present value? Well, NPV is where you take the upfront investment in today's dollars and you add it to the present value of all the future cash flows that will come in years 1 and beyond. Notice that we're taking the present value of cash flows, so we're accounting for time value money or compounding. When looking at this calculation, we need to recall that a cash outflow is a negative number and a cash inflow is a positive number. We're going to be discounting these cash flows at some hurdle rate or some rate of return, which in the textbook by Booth, Clear, and Rikita they call the risk-adjusted discount rate. That is going to be the rate that we're going to use to find the present value of the future cash flows. When we do this in a company for capital budgeting purposes, the discount rate that we're going to use is going to be related to the weighted average cost of capital. That makes sense. The weighted average cost of capital, or WACC, is the average cost of every dollar raised by issuing equity as well as debt. Let's go back to the example we looked at before. You purchase a computer system today for $150,000. Salvage value at the end of 5 years is $40,000. Savings each year are $50,000. And our desired rate of return or hurdle rate is 9%. Is this a good investment? Here we see that by taking the cash flows and discounting them at 9% and looking at all the cash flows, including the cash flows in year 5, we can see that when we sum them all up, we get a positive value of $70,480. This is the net present value. Notice that we're adding not only the upfront cost in year 0, we're adding the present value of all the future cash flows that happen in years 1 through 5. And we're looking at what the total is. That's the net present value. You can see that the discount rates in each period are related to that discount rate. So here shown is year 3, where we have 1 over 1 plus 9% for 3 periods. And the present value interest factor is going to be 0.7722. What's the intuition? Well, the intuition is that $1 received in 3 years is going to be worth 77 cents in today's dollars. Notice that when we sum up all those cash flows, we're looking to see the net present value, where the word net means we're looking at the upfront cost plus the cash inflows. But what does that $70,480 represent? Is that a good number? Or is that a bad number? Well, because we've discounted at 9%, this $70,000 represents excess value in today's dollars that is generated by the project over and above that 9% return. Think about it. That project is actually generating a lot of cash, more than the $150,000, but it was hard to know how much of it was excess until we discounted it. So the rule with net present value is that if the present value of the inflows are greater than the outflows, then you're going to have a positive NPV, and then you're just going to do it. That is a good project. It is going to satisfy your capital providers because you're going to generate a return above your hurdle rate, which is the WACC. Now you may be wondering what discount rate to use to evaluate projects. As we said, the correct discount rate to use for capital budgeting is the weighted average cost of capital. But it may not be the actual WACC because the WACC is an average project. So we have to modify that discount rate based on the riskiness of individual projects, knowing that some are more risky and some are less risky. What do? Well, when a project is riskier, we simply use a higher discount rate than the WACC, and when a project is less risky, we use a lower discount rate than the WACC. Numbers are not going to give you the full picture. You can use payback and NPV as quantitative measures, but you should also do sensitivity. What if you don't get that salvage value in year 5? What if the savings don't turn out to be $50,000 each year? What if it costs more upfront? And finally, what if the discount rate turns out to be higher than you initially assumed of 9%? You need to do what is called sensitivity analysis, which is looking at what if something changes. Be sure to look at all the inputs, the cash flows, the timing, and the risk. You also have to look at how does this fit with the business strategy. Qualitatively, is this going to help the business to be successful? Does it fit with the financial strategy? Does it fit with the business strategy? And look at the pros and cons, because obviously you may have to choose between different projects that both generate a positive NPV. When you do have two projects with positive NPV and you need to compare them, one way to do this is using the profitability index. Here, you're going to compare the present value of the cash inflows that you're going to receive over the life of the project against the upfront cost. So you're going to take a ratio of money in versus money out. This index is going to tell you whether the project is going to generate a positive NPV, in which case the cash inflows are going to be greater than the cash outflow, and the profitability index is greater than 1. But if the cash outflows are greater, meaning that this ratio is less than 1, then it's a negative NPV project. Remember that NPV is simply the sum of the outflows with the sum of the present value of the inflows. So taking a look at this project, we see that it's got a positive NPV of $70,480. How do we calculate the profitability index? Well, we would actually sum the present value of the cash flows from years 1 to 5, which is going to be worth $220,480 in today's dollars. And we take that as a ratio of the upfront cost of $150,000, and we can see that we're making 1.5 times our money. For every dollar invested, you're actually making an extra 50 cents, and so the profitability index tells you this is a positive NPV project. So let's look at another example, slightly more complicated. Let's assume a project requires an upfront investment of $60,000. It's going to generate after-tax cash flows of $10,000 each year for 9 years, and then in year 10 it's going to generate a cash flow of $12,000. If the discount rate is 10%, calculate the profitability index. Okay, so we need to figure out the present value of all the cash that's going to be coming in, and we have a annuity of $10,000 discounted at 10%, plus we have that final payment, you can think of it as salvage value of $12,000, which has to be discounted for the full 10 periods. Adding those two together, we see that we're going to receive $62,216 in today's dollars. All we do is compare that to the $60,000 in today's dollars that we spend up front. As you can see, 62,000 over 60 is going to be slightly more than 1, suggesting that this project has a positive NPV. The NPV is going to be $2,216. So we're going to accept the project. It's a positive NPV.